Coming at you again live from two different places. I'm in Palmer Lake, Colorado, nestled in the foothills of the Rocky Mountains, and my friend Mike Chepka is in the east coast of, you're in Wilmington, Delaware, correct?
That is correct, sir. We're in Wilmington, Delaware.
Very good, and I think we've made some progress on the sound issues. I'd like to just do a check with everybody real quick, and let us know, please, if you can hear us loud and clear. Okay, let us know if you can hear us all right. Use that question answer pod. Rick says sounds okay. Thank you, Rick. Who else is out there? Sounds fine, says Earl. Very good. We've got 42 of you on the line so far, and the number is climbing still. Jerry likes it. Bill, Susan, very, very good. Okay. Thanks, gang. Mark says good. All right. Well, we're going to have some fun today. I've changed up the program just a little bit, but not a lot. I wanted to share today the radioactive profit machine and also two income methods. Some of you may be brand new to this. Some of you may be veterans. I know folks like Bill out there. Hello, Bill. Bill comes every week, doesn't he, Mike? And Bill owns the Blueprint.
When he has the time.
Yeah.
With his schedule.
That's right. Yeah, Bill's a busy man. Okay, cool. What we're going to do, folks, is give you a couple of guidelines. Okay, the way to get the most out of today, you're going to have some questions, and we respect that. We understand that, and we want to answer them. However, many of the questions that have come up in the past with radioactive trading webinars, we have cataloged, we've written them down, and we've actually written the answers into the presentation, okay? So it's very likely that your question will be answered by way of just listening to the preset conversation here, okay? However, we will make some stop at certain points to get some input from you, and also take some questions. We will be happy to take some questions. But if you'll just hold your questions so that Mike isn't furiously typing while I'm talking, and I'm not furiously typing while Mike is talking, that'll help. Okay. All right. At this point, we've got more than 4 dozen attendees on the line, and we can't possibly get to all of you, especially if a lot of you have the same question. Okay. All right. So, and another thing is, if you'll participate in the polls and prompts, like just now, we asked you for a sound check, and everybody participated. Nobody, I shouldn't say everybody participated. A lot of folks participated. Nobody wrote in saying, "Hey, I can't hear anything." So, I'm assuming that that's real good, and we'd really like to continue this two-way conversation. For practical reasons, we got everybody on mute. Because, if you got a dog barking in the background, or your wife is yelling at you, or something, we don't want everybody to have to hear that, okay? So it's just Mike and I going to be talking. Finally, the polls. Let's hit them with the poll here right away, Mike.
Okay.
Right, and I guess we'll do our introduction as we go along. I'm going to make a bold promise to everyone, okay? I'm going to show a simple truth, and it's the principle that all successful traders have said over and over, but they've often said it without the practical directions on how to achieve it. Okay? Cut your losers short, the saying goes. Mike, what's the rest of it?
Well, the rest of it is we want to let our winners run. We don't want to cap our gains, and we want to minimize the losses that we take in our portfolio.
Right. Okay. And doing this one thing can completely revolutionize your trading results. However, practically, how do we do that? It sounds familiar, but how often do we practice it? Well, Mike, I've got a way, and you have been using this, and some folks in the Power Options office have been using this, and folks from about 30 countries now have been using this. It's a way to guarantee that you start in that place where you cut your losers short and let your winners run. Okay? So I'm going to offer that. But first, let's let Mike and I learn a little bit about you. Okay? What is your involvement right now with radioactive trading? Now, I know some folks like Bill that we referred to earlier, and some other folks, they come to these webinars and they review the basics and they give their input, and great folks. Some of you are already heavily involved with radioactive trading. Some of you might be at your first webinar. And some of you might be somewhere in between. You know, you're using the free materials, checking things out. You might be thinking about buying the blueprints. You might already own it. A lot of good feedback coming in the lines right now, Mike. Now this poll is going to add up to more than 100% because you can actually answer more than one.
Mm-hmm.
And perhaps I should have made that clear so more folks did answer more than one. Okay, let me go ahead and close that poll, Mike, and share the results. I'll take a sip of my coffee too. We've got 48% are using the free materials. That's great, but I'd like to see 100%. I'd like to see everybody using the free materials. You know why, Mike?
Well, they're free, and there's a lot that's offered there. And a lot that comes with the free materials, such as the YouTube videos, which are sometimes archived recordings or segmented recordings from our weekly presentations, and also some of the blog information that you have on your site. It still goes along with the radioactive trading technique, but what you'll see is more current examples from time to time, more interaction with what's going on and what are we doing in this market right now, what income methods is Kurt kind of focusing on in this market. So it's a continuation of the learning process. Even though you can trade the entire methodology if you have the blueprint, you'll see some more current examples by following the webinars and checking out some of those archived presentations and some of the YouTube videos as well.
That's right. Yesterday, Mike, I did a blog entry, and I'm going to send that link out to everybody. Now, don't go there just yet. Let's just keep that up there until the end of the presentation. But I'd really like your feedback. I'd like your comments, okay? There's going to be a lot in that blog post, and it's only about 1,000 words. It's a little less than 1,000 words, so I guess 4 minutes reading time, and lots of pictures, which I like as a reader. Lots of pictures. So, but no, we really like to get your feedback and make this available to more folks. Okay. All right. 18% are thinking about buying the blueprint. 42% already own the blueprint. That's marvelous. You may have picked it up just recently, or you may have owned it for years. Either way, I appreciate your involvement. Okay. All right. I'd also like to know what kind of option strategies. Mike and I would both like to know what kind of option strategies you are trading now. And today we'll be talking about some spread trades, Mike, that introduce zero risk, which is kind of a cool twist, isn't it? I mean, to have the idea that you could have a trade in place that takes a credit but does not introduce any risk. That's kind of an interesting idea.
Yeah, I would love to do credit spreads all day long, vertical spreads, credit spreads, or debit spreads if I could do them without any risk, but that usually is the trap that everyone gets stuck into. I mean, they're leveraged spreads, and when you look for the higher probability, what you end up with is one loss. If you suffer the full loss on one position, you might end up wiping out 10 previous gains.
That's right. The more your likelihood of success is, the worse the consequences of the fail can be. When you're looking at those kinds of trades. Okay, and Mike, we've still got folks catching up. We still got folks logging in. Now we're at 61 viewers. Let me go ahead and share the results of the folks that were here and got a chance to cast their vote. 3% don't like options at all, and that's okay. There's only 2 reasons why you wouldn't. Number 1, you don't understand them and therefore have never traded them. Or number 2, you've traded them with not a full understanding and have gotten burnt. And I'm here to say that the cure to both of those ills is education. Mike, I can't think of why anyone that did understand options trading wouldn't want to do it. If they would trade something else, they really ought to trade options, because options will give you the opportunity to have a definite payout or a definite insurance policy. Okay, you can predetermine things up front. Now, 33% are doing cover calls. That's the lowest number I've seen in a long time, Mike.
Yeah, it's very interesting.
I think folks are getting warned off of that. Even though that's the gateway drug, that's how most folks begin trading options in the first place, is that they get exposed to the cover calls trading strategy. It looks like a lot of folks are leaving that, and for good reason. You know, there's a lot of risk to it, and not a lot of reward. Not what's been promised anyway. 55% doing long calls and puts. Our lion's share, about 2/3, are doing vertical and diagonal spreads or butterflies or condors, or basically doing spread trades. Okay. and then 9% making calls. All right, Mike, that's marvelous. It's good to know that about our viewers. And today we're going to have some fun. We're going to take them into some spread trades that have zero risk. But before we get there, we've got to set a little background. Okay, here's a promise, everyone. I'm going to show you a practical way to put that saying to work. Cut your losers short and let your winners run. Okay, and I'm going to prove to you that it will instantly improve your trading results. And we're going to know this by way of polls. Okay, along with the basic setup. I'm going to show you the basic setup, and that alone is going to instantly improve your trading. But added to that, I'm going to also teach, Mike and I together, we're going to teach 2 of the 10 income method adjustments, and there will be spread trades with zero risk. Okay, I'm giving that away today. At the end of the webinar, I'll make a special offer. Today's education is free, and it's going to be 97% education, about 3% promotion. At the end of the webinar, I'm just giving you a heads up. Hey, is the reason that I'm able to do this for free is that I've got a product. If you would think of us first, I think that would be fair after we give you something for free, don't you? All right. I don't want anybody to invest in any program unless I show you how to instantly improve your trading results. But if you do fulfill the promise, is it fair enough that you think of us first when it comes to learning more about how to limit your risk and leave your upside open? And also, we're going to talk about bulletproofing, okay, which nobody else, I think, actually talks about. Okay, is that fair enough? Let's ask you folks out there. Mark says good. Okay, what else? Does anybody else think that that's unfair? Let me know. Rick says yeah. All right, darn tootin'. All right, there's my vernacular. I was born in Texas. Okay, Chuck says yes. Very good. Okay, gang. Very nice. Well, let's get on with it, okay? All right. Best offer available. Thank you, Bill. All right. What's the problem? What is the problem with our trading, Mike?
Well, the main problem, when you break it down to any situation, is we don't know the future. All of these options that you mentioned, all of these combinations we can use, they're all predicated on something happening in the future, that the market, that the stock we're trading, the underlying security, is not going to move and stay within range, that it is going to move one way or the other so we can make profit if we're long calls or long puts, or that it'll move up just a little bit and then stay there, it'll stay where it is and maybe move down a little bit. It's all predicated on a direction, but we don't know the future. If we knew the future, there wouldn't be a market, would there, Kurt? It'd already be priced in.
Right. If there were no, if we could know the future, absolutely, there would be no market. Because the stock market, the options trading markets are a place, it's a marketplace where risk is transferred from one individual to another. And hey, I'll go along with you on the vertical spreads, but as far as a condor trade, we want the stock to stay flat, right? We don't want it to be directional.
Yeah, we want no movement.
Yeah, we want no movement, but can we be proven wrong there? Absolutely, right? And the beauty of the condor trade, I'm not going to teach condor trades today, but the beauty of the condor trade is that at least one of those spreads is going to go your way. You put on two spreads, and at least one's going to go your way. It's best when both of them do, But even with the condor, the problem is we don't know the future. We don't know what's going to happen, okay? All right. I'm going to ask folks if they're happy with their trading results. Now, just before I put up the poll, Mike, I'm going to say if you meet or beat your expectations last year, you should be happy with that. If you lost money, that's just cause to be unhappy. I've had folks say that, geez, I have mixed emotions because I had gains, but I didn't have enough gains. Okay, so Mike, let's pop up poll number 3.
All right.
And then we're going to need this as a basis. We're going to need the results from this poll as a basis to see if we've shared anything of value during the presentation. Okay, so very good. We're about 15 minutes in, and just getting to the meat and potatoes. I think we've set a pretty good foundation here. Learning a little bit about our viewers. Viewers, you're learning a little bit about us. Okay. My goodness. Mike, I haven't had anybody say great year in 2010 yet.
Oh,
Folks, if
no.
you're out there, yeah, if you're out there, folks that meet or beat your expectations, you beat your expectations, please give us your input, okay? So far we've got 54% of our viewers have cast a vote. I'd like to see that up to 100%. Our international viewers, that that saying at the end, man, I'm ready to throw in the towel, that's a saying that goes with boxing. The coach will throw in the towel if he thinks that his fighter's getting beat up too much. And if you think your capital is getting beat up too much and you feel like, man, I'm ready to quit, why take any more beatings, then that's how you would answer, okay? Sometimes I forget that we have an international audience. Not everybody hears throw in the towel very often. Okay. Okay, Mike, let me go ahead and share the results, okay? We had 0% say that I'm ecstatic. We did have 30% say happy, but could stand to be happier, so that's good, okay? These folks did all right. 45% mixed emotions. The winners have kind of outweighed the losers, or maybe the winners have taken down the losers have taken down the winners to where you can't really say I'm happy with my trading results, but you also can't say, man, I lost. Okay. 20% had overall losses, and 5% say I'm ready to throw in the towel. How about that? Okay. Well, let's go ahead and hide that, and we're going to show a solution. Okay. All right. Why has the problem not been solved? The problem, as we identified before, is just not knowing the future. Okay, and a lot of folks think that they know the answer to the problem, and I'll bet you that if we've got right now we've got 65 people in the room. I'll bet you that if I pose this question to all 65, I get 65 different answers. Strike that 66. We just had somebody else join us. We get probably 66 different answers, but they probably fall under just a few categories, okay? I'm going to ask, and this whole presentation is not going to be polls, okay, guys? But we want to communicate. We want to go back and forth, and some of these polls are using the Socratic method of teaching. I'm teaching by asking questions, okay? All right, so what thing do you think is your solution? What do you think would improve your trading results, whether you're happy with it or not happy with it, okay? And I want it to be a single thing, okay? So just look at this list of 5 different solutions or categories of solutions. Do you think you need to spend more time with selecting the right stocks, or you're right more often, or when you're right, you're really, really right, you pick a good one? Do you think you need a more reliable system for timing, getting in and out at the right times? Do you think you need to spend more time trading? Or if you could just simply limit your losses more, no matter what way it was, would you do that? Would you like to make your wins bigger? Okay, let's give this poll about another 15 seconds. It'll be up a full minute then, Mike, and it's very revealing already. It's very revealing already. In 3, 2, 1. If you haven't got your voting, get it now. And presto. How do I close it? Okay, there we go. Close. Okay. Nobody wants to spend more time trading. I don't blame you. 6% think that their time would be well spent if they spent more time with stock selection. Okay. 14% want a more reliable system for timing their trades. Okay. And 14% want to make their wins bigger. We are going to show how to do that. Or actually, I've shown that in other presentations, Mike, haven't I? How to make your wins bigger, not settle for 5% a month or something like that.
Yes, we have.
That's right. But 67% say limit my losses more. That's almost 7 out of 10. Just intuitively, you're knowing, man, I need to just limit my losses. And it's true. The interesting phenomenon is, Mike, that if we don't lose too much, we've got more to trade with on our winning trades. Okay, so if we could just do that, that would be the tickets. Okay, and that's what I have to offer. I don't have stock selection criteria to give you. I don't have a timing system to reveal. I don't I don't know how to manufacture more time in the day for you to do your trading, okay, but I can certainly show you how to limit your losses more and make your winners bigger. Let's review the saying, cut your losers short and let your winners run. Does that strategy of selling covered calls go along with that? Mike, is that congruent? I mean, if I want to let my winners run, can I do that with naked puts?
Or covered calls? No. I mean, what we end up doing is we cap our upside gain. If things go right, I mean, we can make a decent percentage return, but the problem is that we can't have an unlimited upside profit potential. And everyone says, sure, oh, you can roll the call or you can roll the put. Well, sure, but if I'm rolling a covered call to a higher strike price, I'm going to be paying more into the position to roll the call. I'm going to be adding money to make that adjustment to hope that I get assigned at the higher value. But if you just look at the profit and loss chart, your gains are limited on the upside, but you're still taking on 95, 96% of the risk of just owning the stock outright.
Right, so there's not really that much protection either.
Right, that's exactly right.
What about the vertical spreads and condors? Now that does limit your risk. That does make it so that you don't get hurt too badly if you do get hurt.
Well, you go into the position knowing what your maximum risk is. You know what the maximum monetary loss you could take on the position. But in order to set up a vertical spread correctly, where you have the higher probability of being successful, the risk that you're taking might be 5 times, 10 times, or 20 times the potential profit you're going to make. And that's a risky investment.
Yeah. What if, what if, for example, Mike, the stock is trading at $50, and I buy the $50 calls for $3, and I sell the $55 calls for $1. So my outlay is $2. I could lose all $2, right?
That's exactly right.
Okay, but if the stock goes to $100 a share, wow, hey, do we get to participate in all that upside, or what's our maximum profit?
Well, the maximum profit in that case would be $3. The difference in the strike price is 50 and 55 minus your net debit of $2. So you would make $3, and that looks like a great return. You know, everyone's saying, well, wait, Mike just said you might be risking, 5 times or 10 times. Here, we have the potential to make more money than what we're risking. Well, the problem with that situation is that you have a lower probability of the stock going above 55 to realize that maximum profit.
Right, but if it does go way high, we don't really get to participate, do we?
Not at all.
I mean, yeah, if the stock doubles, it goes from 50 to 100. Well, we make a profit, but we don't make a big profit. You see, Mike, I got hurt trading covered calls, and part of my introduction is that I was one of these guys that went to these seminars in the late 90s that they charged $3,000 for a weekend, and what you come out of there knowing is you know how to do a couple of spread trades and covered calls. And so I was doing covered calls, and I was doing it according to the directions I was given, and went broke. All right, and Mike, this is actually kind of backwards of the saying. The saying is, cut your losers short, let your winners run. Well, I'm actually doing the backwards thing here.
Mm-hmm.
Is this a little bit more congruent, Mike? Maybe having stock in place that it could go up, but also instead of mixing your stock with a short call, mixing it with a long put to keep your losses reined in case you do lose, and at the same time leave the upside open in case the stock is a winner. Is that more congruent with the saying?
Yes, it is. We've got a very defined floor of the amount of money we're risking, and we have an unlimited upside profit potential that's not capped by any obligation from selling or shorting an option.
Right. Now, I made a promise. I made a promise to show some spread trades that are done with zero risk. A debit spread that can't lose, and a credit spread that also can't lose. And I'm going to show that, okay? But just before we do, let's look at the solution to the problem. What is possible with this idea of beginning with a married put trade, okay? It's possible to set up a structure that limits your losses to a very small amount and yet leaves your upside wide open. And I call it the radioactive profit machine. It's basically a married put trade, but it's done in a specific way. And before we look at the structure, I want everyone to we found out that how many was it? I want to see who is using the free materials. 48% were using the free materials, okay? The sketch, YouTube videos, the resources page. I'm going to say, look, guys, go to the resources page and do this on your own, okay? You can do this on your own after we're finished here today, but right now I'm going to go to it and be careful because I just might reveal to you how you're going to beat the market in 2011, okay? And it's the trade simulator on the resources tab at radioactivetrading.com. Let's go there now and take a look, okay? All right. Oh, I got to get out of administration. I've got to sign out in order to use this. Okay, here we are. Resource page. And we go from the resources page to the trade simulator tool. And Mike, let's if I could flip a coin with you, okay, and every time that you won, let's say we're flipping a coin, every time that you won, I give you a dime, but every time you lose, I take a nickel from you.
Okay.
Now, you've inspected the coin, all right? So you know it's a 50-50 chance. Would you play that game with me?
I would love to play that game. Yeah, so every time I'm right, I make 10 cents, and every time I'm wrong, you only take 5 cents away from me. I think that'd be a good game to play.
That's absolutely correct. Now, Mike, a lot of folks don't understand how to skew the chances in your favor, okay? It's not really the chances. It's not the probability that we're skewing, that we're messing with. It's the target return to loss limit. Let's just start with this on the trade simulator tool. Target return of 10%, loss limit of 10%, probability of a loss same as a coin toss, okay? This goes along with just not knowing the future, okay? We don't know what's going to happen, so 50-50 either way, right? Okay, now I know that there's folks out there that are really good at timing the market, and you can be right more often than half the time. Okay, good for you, okay? But I'm going to actually assert and say that it's possible to be wrong more often than you're right and still make money. First, let's check out this, okay? The target return 10%, loss limit of 10%, probability of failure. Okay. Now, we have a starting amount of $10,000. I'm going to hit the simulation result. What's going to happen is we're going to have a virtual coin toss here, 100 different times that coin gets tossed. The coin gets tossed 100 times, okay? And when we win, we make 10%. When we lose 10%. And what happens? Well, Mike, here we already had one. 55 wins, 45 losses. The $10,000 at one point rolled it all the way up to $21,325. At another point, the low value was 63.31. Okay, so that's a 37% drop. And the net at the end was $16,501. So a 65% return. Pretty cool?
Pretty cool. And remember, this is not a promise of an exact trading record. This is just a simulation with this win-loss record of flipping the coin 100 times, looking to make 10% when you're right, risking 10% when you're wrong.
That's right. And what we're doing is we're just introducing, the math that goes behind risk management. Okay. And if you want to do this on, you want to put in your commission structure, whatever your broker charges, you can do that too. Okay. But Mike, let's run this simulation again. If we're right more often, we're going to probably make money. But we weren't. Here we had more losses than wins, so we took our $10,000 and ran into the ground. Now we have only $1,800. That's a 72% loss. Let's run that simulation again. We just need to be right more often, don't we? Wow.
Yep, still not there.
Even with, yeah, we had 4 winners out of the gate. Look at that, 4 winners out of the gate, and mistakenly, we were believing that we had a winning system on our hands because we're up 46%, right?
Oh, yeah.
But then we got her. So, okay, let's try one more time. Got to find a winner. We got with, okay? Yay! All right, there we go. Let's write this down. Can we write down the results of this, Mike?
I got it.
56% winners. Yep, 44% losers, of course. We took the $10,000 up to a high value of $23,000. Low value along the way of $6,725, right? and an ending amount of $20,000. So we doubled our money. That's pretty good. Okay, but here's what I'm going to do, Mike. I'm going to run up here and I'm going to change something. Do I really have control over how many wins and losses I'm going to have? What the market's going to do?
No, the market is rampant chaos, and you can't predict if you're going to be right 56% of the time or right 46% of the time. You don't have control how many times you're going to be right.
That's correct. We can look at our back results, and maybe have an idea, but we can't control the future. But Mike, here is something that we can control. Can we lower our expectations instead of holding out for a 10% return? Could we lower expectations to say 8%? Is
Sure.
that within our realm of decision making? Yeah. Well, what about this? Using the structures of the married put, can we keep our losses down to 5%, say 4%?
We can easily define the loss limit, the maximum loss we're going to risk on any trade, whether that be 4%, 5%, 6%. We can determine that.
Right. Okay. So, Mike, I've actually taken down the target return. The target return had been 10%. I'm going to take it down to 8%. And I'm also going to use options to structure keeping myself out of trouble. So now let's see what happens. Okay. Now here we had more winners than losers. So obviously we're going to do well. Okay. But let's find a trade where we have more losers than winners.
How about that?
Oh, looky. That's interesting. That's very interesting. Mike, when we had the winning record with a 10% target return, what was our best result that we came up with?
Well, that 56 wins, at one point we took the high value of that account, being right 56% of the time, to $23,564.
What was the low?
The low was $6,725.
So about a 23 or 33% loss?
33% loss, sir.
33% drawdown. So at that point, our spouse might be screaming at us and saying, "Hey, let me handle the money." Right? What was the end result, though? I mean, we did okay at the end of that. The end result of the 10% and 56 wins. How much did we make?
It ended up in that scenario, that simulation, at $20,168.
Okay, and that's winning more often than you lose. Mike, we lost more often than we won in this particular scenario. Our low value was not a 33% loss. It was about a 10%, right?
That's right.
And our ending amount was more than double the results. Isn't that something? Did we add to our target return?
No, we restricted our target return and said, okay, if we make an 8% return, we'll close the position rather than seeking a 10% return on our positions.
Right. So we actually lowered our expectations and still did better. And here's why, folks. It's because of limiting the losses. Okay. So remember, I said earlier, let's go back to the presentation. Okay. I said be careful because I might just show how you're going to beat the market in 2011. Okay. Now I was being facetious there. You definitely want to beat the market in 2011. Okay. But let's say this, Mike. Let's not take my word for it. Let's ask everybody out there with the basis that we already gave you. Okay, if you were to cut your losses from whatever they were to say 6% or less, would you be happier? And I want to explain that it's not 6% of your total capital. It's 6% in any one trade. So that any trade that you got into last year, if it lost miserably, the most you could lose is 6%. So you'd have 94% of your capital from that particular trade left. And maybe you didn't put all your capital into it. Okay, so let's go ahead and launch that poll, Mike, and we're going to share the results, and then we'll have the stage set to get into our riskless spread trades. Okay.
And
okay, folks, are we voting? Oh,
yeah,
okay.
They're voting. I just wanted to mention that Benit pointed out something. I think we're all wrong on the math here. That loss that we just showed on that losing one, it wasn't a 10% loss, Kurt. It was only a 1% loss. The low was 99.07, so we lost $100 off of a starting portfolio of $10,000. So it was only a 1% loss, and you and I had said 10%. by mistake.
Oh, you're right. My goodness. Yeah. You're right. And that's actually having more losers than winners.
That
That's
was
really
right, yes. But we got to be right on the math. We always want to be right on the math, so that was just an oversight. So it was a 1% loss that would have been suffered in that case, not 10%. It's the day after a holiday, so you know how that goes.
That's right. Very good. Okay, Mike, I've had that pull up for a minute, so now I'm going to go ahead and close it. If you haven't got your vote in, please put her in now. And 3, 2, 1, blast off. Okay. I know that some folks were still trying to get their votes in, but we had to cut it out. Okay, so 3% would have still lost money. So I'm going to say out of the 100% that voted, the 3% that would have still lost money, I'm going to say that you're probably trading too often. If you're keeping your losses to less than 6%, I have to assume that you already are keeping your losses to less than 6%. Okay. Geez, if you're doing that and you still lose money, you may be over trading. You may be taking small losses, but taking lots and lots of them. Okay. All right. So to the other 97%, 13% would have said I would have lost less. 32%, that would make the difference between a winning year and a losing year. All right. 39%, that would put me over from unhappy to happy. Now, Mike, could you have a winning year and still be unhappy?
Yeah, I mean, if you only made 1 or 2% total in your portfolio, but the market as itself was up, let's say, 8% or 9%, I could see you having a winning year and being slightly unhappy because you didn't beat the market, as you mentioned earlier when you launched that first poll.
Exactly. That's the reason that I put those two separate questions in there. That makes the difference between, happy and unhappy, or the difference between losing and winning. Okay. All right. And 13%, I said I was happy with my trading results, but I'd be more happy. Okay. So, Mike, unless I'm reading this wrong, 97% of our trading audience would be in a better position had they done this.
I concur.
Am I correct?
I concur, absolutely.
I concur. Very good. Okay, let me go ahead and hide those trading results. Okay, so I helped 97, and 3 of you not so much. So let's see if I can help the other 3. I did say that we were going to show some riskless spread trades. Just before we do, I'm just going to ask folks to put a number on it. Okay, can you put a dollar amount on how much better you would have done? And this is only to the 97% that said they would have done better. Okay, the 3% that said, "Geez, I would have still lost money." Don't participate in this. Okay, or maybe you could participate in it. You could say, "I can't see how that would help." That's the first answer. I can't see that forced loss limits would even help. 7% would have saved at least 300. Oh, now it's down to 6. Now it's down to 5. It's because more and more folks are casting their vote. Hey guys, don't break out your calculator and go over your whole last year. Just kind of guesstimate, okay, for this particular answer. All right, we'll give it 3 more seconds, 2 more seconds, 1 more second, and blast off and share. Mike, more than half, 55%, would have saved or made $5,000 or more. Nobody said, even though we did have 3% in the former poll, it said that it wouldn't have worked out for them. I did say don't participate, and I should have not. I should have allowed them to say I can't see that would even help. Okay, but nobody said that. Nobody said I can't see how that would even help. 3% would have saved $300. 32%, 1,000 to 5,000. 55% would have saved or made $5,000 or more, and 10% recognized the truth that, gosh, when your stock tanks and you were you were going to lose 6%. So now you have 94 of your marbles left. Now you can buy again at the bottom. That's kind of a cool idea. Okay, Mike, let me go ahead and hide that, and we put a number on that. I'm going to go ahead and mention that about this time last year, it was April. Okay, so about almost a year ago, in Colorado Springs, I did one of these classes live, and I went around the room. One raised his hand and says, "Try $30,000." That's quite a bit more than $5,000. I said, "Sir, do you mean you would have saved $30,000 last year if you'd have known this method of trading? And he says, no, I would have saved $30,000 in my worst trade. So, so wow, okay, good. I'm glad I'm here. And he bought the blueprint on the spot, and a few for his friends. So that was kind of a good deal. Okay, so enough theory, Mike. We've got to actually show folks how to do this. Okay, we've got to show them how to set it up. So let's show the structure of an RPM, which is the beginning structure, and then after the beginning structure, we're able to put on those riskless spread trades that I was talking about. Here is my most recent deal. January 7, 2011, I picked up shares of NTAP at $56.50, while at the same time buying June 2011 $65 puts. Now, Mike, that's an interesting setup there. I mean, this is January. Now it's February. But here in January, I'm buying puts. Is that a little odd?
Well, yes. If you've ever read any free materials at your broker or any free options books or just free education, they'll describe the married put or a protective put, as buying shares of stock and buying a put option that's only 1 month out at a time, so you're not paying a lot of premium. Well, the problem is then you have to, if you're going to continue to hold the position, you have to buy insurance month by month by month by month, and that's going to increase your annualized cost. Now, what you've done here is you've gone farther out in time, but you also did something else that's a little bit interesting too. And that's that normally when you look at those positions on a married put, I might buy a put option that's out of the money, that's below the current stock price. But here what you've done is you've bought an in-the-money put. You've bought a put that's above the current stock price and several months out in time.
Oh, how about now?
You're good now, yeah. Sorry, you disappeared there for half a second.
Yeah, I was actually saying the same things you were saying, but I'm glad that you were there because probably nobody else heard me. Yeah, the option is in the money, and a lot of folks will look at that and they'll say, "Man, that is expensive. That's a lot to spend on insurance." In fact, I think you said something like that to me.
Now, the first time you had mentioned this to me when you were a customer of Power Options, I said, Kurt, I understand what you're doing and I can show you how to use the tools to identify these positions, but right now I don't get it. I'm sure I see that you have a limited risk in place, but you're not going to make a penny until the stock's trading above $67.50. You've invested so much in this position. Wouldn't you be better off just buying stock if you expected this move?
Right, and since then we've learned differently, have we? The stock does not have to approach 67.50 before I can actually be bulletproof. But let's just move on here. I'll say that the guaranteed guaranteed exit here, Mike. This is kind of like having a stop order in place, but instead of a stop order, it's an absolute. I can definitely, anytime before June anyway, I can definitely get out for $65. So the at-risk amount is the difference between my total investment and that price, that strike price. So it's $2.50. Now, when you set that $2.50 against the $67.50 I've used, well, that's 3.7% risk. Okay, so that's the beginning point of any radioactive trade. You buy the stock because you're bullish. Okay, and if the stock goes up, you're making money. Right? Now, if the stock goes down, you could lose money, but you're not going to lose more than what your put says. Okay? And then that dashed line, the break-even line, in the case of the setup I just showed, that break-even line is supposed to be 67.50, but that's really not the way it behaves, is it, Mike?
No, not at all. That's the break-even at expiration. If you held it all the way to June expiration, you made no adjustments, and the stock was trading at 67.50. Those three things have to happen for you to be right at that break-even point.
That's correct. Okay, and I'm in charge. I'm in control of two of those three factors. You know, I have nothing to say about what the stock is going to do. The stock is going to do what the market wants it to do, right? But as far as adjustments, I made an adjustment the very first day with this. And also, Mike, I don't have to hold it all the way till expiration, do I?
Not at all. You have the choice to get out early. If you've reached your personal goals for the positions, you can liquidate the position early. Or if it's going against you and you decided, well, okay, I guessed wrong, let me get out now. for maybe that 3.5-3% risk.
Right. Yeah, it was 3.7, which is less than the 4% that we plugged into that trade simulator tool. Well, here's the deal. Okay, that maximum loss is the maximum loss that I can possibly lose if I go into a coma and the stock is trading below $65 at expiration. Okay, so let's just go ahead and compare 3 different ways to play long stock. Okay, Mike, if we have long stock and we don't hedge it one way or the other, or if we have long stock and we hedge it with a covered call, or we have long stock and we hedge it with a put option. Okay, if your stock goes up 20%, how much do you make if you're just owning stock?
Well, we'll make 20%, not including commissions, but we own the stock. Stock moves up, we have a 20% gain.
Right. Now we're going to limit ourselves with the covered call, right?
Right. When we sell the call, we entered into an obligation to deliver shares of stock at a limited price. So we might only make 3, 4, 5% in this case once we get assigned.
Okay. And you and I know that the put option is going to go down a little bit if we buy stock. Okay. We're going to make less. Let's say that we cut into our earnings by 5%. Okay. So here's the deal. All 3 positions made money, didn't they? If you own the stock, you make money. If you ran a covered call, you make money. And a married put is going to make money. It's just going to make less.
Yeah, they're all essentially bullish strategies, right?
Right. Okay. All right. Now, let's do a new play. We take our wins from that. We put it into another play. And now we get into a stock that goes down by 20%. Okay. Well, we're going to lose 20% in the stock, right?
Oh, yeah.
But the covered call, the covered call is going to lose less because we take a premium. Okay, and I'm going to be real generous here, and I'm going to say that we took a 5% premium. Okay, so the covered call loses 15% net. Okay, but the married put set up the way that that I've been showing, you could keep your risk to about 5% or so, right?
That's right.
Okay, now here's the deal. Here's why that trade simulator tool is such a valuable resource, okay? Because you can look at and see how math really behaves. You see, when the straight stock makes 20% and then loses 20%, Mike, that sounds like a net zero. It sounds like you're flat, correct?
Sure, yeah, make 20%, I lose 20%, I'm back to break even, aren't I?
Nope, you're really not. Okay, and I'm not just talking about commissions. I'm talking about the way math behaves. Okay, you have a net loss here of 4%. Let me explain. If you had a 20% win on $100, multiply times 1.2. That's how you get it. You'd have $120, right? If you were to lose 20%, how would you multiply then?
Well, we've got $120, but we're going to lose 20% of that $100, which is actually going to take us down to $96.
That's right. You can look at it one way, and that's to multiply by a fraction, okay, 0.80. All right, that's a fraction. That would mean losing 20%. Or you could just say, okay, 20% of 120 is $24. So 120 minus 24 equals, same thing, makes 96. See, the thing is, you make 20%, lose 20%, you're behind, okay? It's even worse with the covered call trade. Okay, why? Because we did not allow our winners to run. We cut our loser a little bit. Okay, we lost less, but we ended up in a worse place. And a lot of folks that have been trading covered calls understand this. We understand that, geez, you know, this kind of limits your upside and it sorts out the winners. The winners come out of your account and you're stuck with losers. Not cool. Right? Remember, Mike, this was the same stock all 3 times. The married put makes less when it goes up, but then it loses a lot less when it goes down. So out of the 3 different plays, what actually made money?
Well, only the married put made money, didn't it? The other 2 resulted in a loss after having the stock go up 20% and then having the stock drop 20%. In the case of the covered call, it was a pretty significant loss in the position.
That's right. Okay, and that's the beginning point. Okay, now for those spread trades. Okay, we cut the losers short, and we let our winners run. Okay, so what's different now? What's different now is that got a strategy that's congruent. Okay, it fits, And just real quick, I'm going to show we had 97% fall in one category or another of, geez, if I just traded that way, I would have done better last year. 97%. Okay, so I fulfilled my promise to most of you. And what about this? Care to put a dollar amount to it? Well, this has been valuable to more than 5 out of 10 of our attendees. This has been valuable to the tune of $5,000 or more. This for 1 year. How many years are we going to be able to use it? Hopefully the rest of our lives, right?
That's right.
Okay. Yeah. So we have done something, I think, for our attendees so far. But now I'm ready with all the build-up to show some riskless spread trades. Okay. Okay. So what else is different now? Here are the adjustments. I call them income methods because they're almost always done at a credit. Sometimes they can be done at a debit, but to guarantee a higher payout. We're going to show one each of those, okay? So let's go back and review the setup, all right? January 7, 2011, the NTAP shares at 56.50. I've bought a put option that keeps me safe to where I can't possibly lose more than 3.7% anytime between then and June. Okay, now, this is scalable, by the way. Instead of doing 100 shares, I showed it with 400 shares. And so that ends up being $1,000 of the portfolio at risk. If you're trading a 6-figure portfolio, if you're trading $100,000, that represents 1% of your entire portfolio. Does that make sense, Mike?
Yeah, we don't want to risk too much in any one position, not only just on the position by itself, but of our total account value.
Right. Now here's the graph. This is the familiar hockey stick graph. The blue is the bottom line, okay, and then where it could go after expiration, okay? So if we're at 67 or better, we're making money, right?
Right.
But Mike, what's this red line all about?
This is showing you the curved red line. This is showing you the profit and loss using the Black-Scholes pricing model, in this case at about the halfway point. On April 20th, you see that you don't, in order to break even based on the time value you still have left on the put, we might only need the stock to be trading at around 62, maybe 61.50 per share, and we'd be at break even.
Yeah. So actually my break even requirement is a lot lower during most of the life of this trade. This shows that in April 20th, that my stock would actually only have to be at 62 or 61 or so for me to be breaking even, not 67.50. So that's kind of a little bit of grace there, isn't there? Okay. Here's another thing, Mike. I can do adjustments. Here's the maximum risk. The maximum risk is $1,000, okay, or 3.7% of what I've put in. That clearly shows the married put. Go ahead.
I was just going to say for the 400 shares, right?
Right. Okay. Now, I said that I was going to show a riskless spread trade. First, let's look at a bear call spread. Okay.
Okay.
If we were to do a bear call spread and pick up, say, $1.26 on each of 4 contracts, the maximum we could make, $1.26 times 4, the maximum we could make is $504. Now we make that $504 if the stock's at 35, if it's at 40, if it's at 45, 50, okay, 53.70, which is where it was then, all the way to say $55. In fact, there's even a little bit of grace that if the stock goes up to $60, we could still be making money, okay? But what happens if the stock goes up above, what is it, 60?
60 is your short strike. Yeah, this bear call spread looks like it's selling the 60 call and buying the 65. And
yes.
Yeah, sorry, Rob just asked, can you explain a bear call spread? A bear call spread is a directional position that gives us this profit and loss chart where we're going to sell an at or out of the money call. In this case, it's the 60 strike call. And at the same time, we're going to buy a 65. So our goal is to have the stock remain below 60 at expiration. Both options would expire worthless, and we'd keep the net credit, which in this case was $1.26 times 4 contracts, that 504. Now what this is showing you, actually, this profit and loss numbers on the left, this was at the halfway point at 218, I believe. I believe this is a March series that you're using here, Kurt.
That's actually, it's a February series. This has already been done. I've already done this spread trade.
Oh, I see what you did. Okay.
It actually gave me the maximum credit, but it could have been bad. It could have gone against me. So why don't you continue explaining how badly this could have gone?
Oh, well, you see now the risk here, Robert, is what's the problem? The problem is if the stock moves up. If the stock moves up above 65, we're obligated to deliver shares of 60 that in just a spread by itself we don't own. We have bought the right to buy them at 65. So we buy shares of stock at 65, sell them at 60, which results in a 5-point loss. But we still keep that $1.26, so our maximum risk is about $3.74 for potential to make $1.26.
Right, and when you multiply it out times the 4 contracts, the maximum loss could be $1,496. See, I'd take in $504 by doing this credit spread, but I could lose up to $1,496. Now, here's the deal. I told you that it was a 0% at risk. It did not introduce risk. And I wasn't lying. I wasn't lying, okay? It did not introduce any risk. But by itself, doing a credit spread would, a credit spread with those parameters would risk $1,496 and only give you $504. Okay? All right. Now, the radioactive profit machine where I buy stock plus what has $1,000 at risk. The income method number 6 play, which is bear call spread done within the context of a married put, that has $1,496. So, Mike, what do you think the risk ought to be? Actually, I should ask the audience. Audience, what do you think the total risk ought to be if I do both of these trades? If I do the married put trade with $1,000 at risk and the bear call spread trade with $1,496 at risk, what should the total risk be? Okay. Anybody care to take a stab at it? $24.96 says someone. Says, is that Randolph? Rick says $4.96. Gotta go, guys. Good stuff. All right. Sorry. We'll see you. Okay. Let me go ahead, Mike, and share this, okay? If we combine the two, what happens is we take that flat line and we boom, put a little heartbeat on it. Mike, is there still an unlimited upside to this trade?
Yes, because you have a long call now and you still own the stock. This is a spread trade nested in the form of the married put. As the stock spikes up, if it went up to $80, $90, or $100, you still have an unlimited upside profit potential.
That's right. And this blue line, again, is at expiration. Now, at expiration, it shows it dipping down below this break-even line. But what's this red line all about again?
Well, that's the halfway point, isn't it, Kurt? Halfway between now and the expiration date.
Yeah, if the stock gets to a place, if it gets to $65 and a place where the maximum possible loss is realized by that bear call spread, why then I'm able to manage it. I'm able to do things that I put in the book. I'm able to do some things to make it so that I guarantee myself a profit. How about that? Okay, what has happened here is, Mike, I've taken a $504 credit to take on the risk of the bear call spread, but it's no risk at all because I own the stock. Right. Here's the deal. Rather than $1,000 at risk, rather than $1,496 at risk, the sum of both of them is $520, and that's assuming I make no adjustments. Will I make an adjustment, Mike, if it looks like if my stock goes to $65?
Sure, you have different ways to manage that income method number 6, that nested bear call against the RPM.
Right. The bear call spread introduced no risk, and it did take a credit. Now, Mike, last Friday, that bear call spread expired worthless, so I did realize the full $504 credit, so that reduces my cost basis on the stock, right? Mm-hmm. It can be done repetitively to take out all risks. Last expiration Friday, my bear call spread's worthless, so that took my risk from 3.7% to now 1.9%, but do I still have the unlimited upside?
Well, sure, because now your obligation is completely canceled. You've generated income which reduced your risk, and you don't have anything else open that's capping your gain.
Right. And I can do income method 6 again if I like to, or one of the other 10 income methods. the other 9 income methods. There's 10 total.
Mm-hmm.
Okay, so Mike, here's the deal. By doing the bear call spread, I took a credit but introduced 0 risk. All right, so that's one way to do it. Okay, now we'll go ahead. How much time have we got here, Mike? What time is it now?
We're right at 1 o'clock Eastern, sir.
Okay, and usually we go as far as 15 minutes in. I'm going to ask folks, look, do you want to see the other riskless spread trade, and also a kind of a bonus? And I could probably do it in the next 10 minutes. Yes, 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 yes. Okay, we got lots of yeses. If anybody needs to sign out, Mike, are we recording this?
I am. Yes, sir.
Okay, good. All right, so I just want to be respectful of everyone's time, but I also want to give you what you came for, 2 riskless spread trades plus a way to nest them within each other afterwards. Okay, Mike, this is a historical income method number 4 trade. Now, you and I have both done income method 4 trades as recently as just a few weeks or months ago, all right? But I'm going to show one that was done a little more than 4 years ago, and the reason that I like to show this is because the math is really simple. And also, it's recorded out there on the internet. I posted this trade in an ops trading forum at the time that I did it, and it was part of an online debate I was having with the moderator of that forum. He said that, geez, doing this is profitless. It's a bad idea. And I just said, well, I kind of beg to differ, and posted this trade. And since then, he and I have become friends, and I've actually presented some things to his group. But Mike, let's, without any more background, let's just go ahead and look at the trade here. I picked up shares of DIA at 115, and at the same time, in January 07, $119 put option for $5. So my total invested is $120, and my insurance policy says that I can get out at $119. Okay, so what's my total at-risk amount?
Well, your total at risk is only $1, and this is less than 1% of your total investment.
That's right. Okay, we did have a question come in. I think that Benit wanted to know if we keep the Mary put open. The answer to the question is, if we want to. Yeah, I've still got that particular position open. Okay, now Mike, here we are on the income method 4 trade again. The stock went from 115 on September 25th, 2006 to $120 on October 19th. And that's not a really big move, is it? That's not really big.
No, it's less than 5%, isn't it?
Right, okay. And the January 07 $119 put option had been priced at $5. Now it's down to $2.05. Okay. So a lot of folks will look at that and they'll say, Kurt, you're losing on the put. That's the big objection. Okay. I want to show you a really interesting phenomenon, Mike. Take a look at this. This graph here on the left represents the intrinsic value of the put plus the time value in the put when it was trading, when the stock was trading at 115. A $119 put option was $4 in the money. Okay, so $4 is intrinsic value.
Right. And
since it was priced at $5, okay, the remaining dollar was extrinsic or time value, right?
Mm-hmm.
Okay. Now, the total value of the put went down in October because the stock went up. But isn't it interesting? The time value increased. See how much of the time value is there and how much it is there? Let me just take out the intrinsic value. The biggest objection I get from folks is they say, well, that put is just too expensive. Well, the best insurance is expensive. And the second biggest objection is that I get is, hey, if the stock goes up, I'm going to lose on the put. No, you won't. You're not going to lose on the put. For every dollar that the intrinsic value went out of the put option, it was because you gained $1 in the stock.
Mm-hmm.
So is there any loss at all?
Oh, it's just trading, isn't it?
Yeah. It goes from one column into the other column. You're not losing. There's no net loss. If your intrinsic value, if you buy the put in the money like I show, if the stock goes up, your put does go down, but the intrinsic value is the same.
Mm-hmm.
The extrinsic value, the time value, swells. The time value of this put has actually gone up. Here's the prices again. Oh, hang on. As the intrinsic value, I guess this is all of what I just said, okay? As the intrinsic value of that put moves down, it only can be because the stock has moved up. For DIA to go up by $5, it had to go up by $5 for my put to lose $2.95. Is that okay with you? Mike, if I borrowed $2.95 from you, but I paid you back with a $5 bill, would you be okay with that?
I think I'd be fine with that, absolutely.
How about 100 times? Would that be okay too?
That's right. Mm-hmm.
Yay. Okay. So what's happened is the price of the put that had been priced at $5, now it's priced at $2.05. But the time value has actually gone up. Now, why does this have anything to do with the price of tea in China? Let me show you. Okay. On October 19, 2006, I did the spread trade. I bought the 2008 $128 put options for $9.70, and at the same time I sold January 2007 $119 puts that I was holding. Okay, and they were priced at $2.05. So, Mike, is that a debit or a credit?
Now, on this one, you're going to pay you're going to pay a debit to apply this adjustment. You're selling to close your original put. You're buying to open another put that's that's actually a year further out in time. You've moved from January 2007 to January 2008, but you also moved up in strike price as well.
That's right. Okay, so let's do an audit here. Some folks are probably saying, wait a minute, Frankenberg, you spent money, you didn't take it in. How is that an income method? Let me tell you, all 10 of the income methods are done at a credit, or can be done at a credit, except for this one. This particular one, you spend money, but you guarantee yourself a higher payout. And let's see how that works. Okay. On September 25th, DI was trading at 115, and I picked up the $119 calls for $5. So what's my expenditure so far?
Well, you've put in 120. Saw that on the first screen.
Right. So when I turn around and do this spread trade, this income method number 4 that introduces a debit, I paid $7.65 to do the trade. So now my net cost so far has been how much?
Well, now your total investment is $127.65. You added money into the position.
Yes, but if you'll recall, I swapped a 2007 expiration. I'm sorry, 2007 expiration trade put at 119 for a 2008 expiration put at 128. This is my new key to exit. If something happens, if planes hit the Twin Towers, or if a Great Depression happens, or something bad goes down, Mike, I can get out at 128. What's my new risk?
Well, your new risk is negative. You're now guaranteed an exit price that's higher than the total amount into the position. So this is what we call being bulletproof. You're guaranteed to make at least 35 cents, but you still have an unlimited upside profit potential. Well, right now you do. I should say that.
Correct. Okay, so this red zone here just describes everything that I've shown so far. Buying the stock and the put, and then swapping the puts out, making it bulletproof to where I can't lose. Should I mention, Mike, that DIA pays a dividend?
Mm-hmm.
I should also mention that my new position is valid all the way till the end of this chart. And Mike, there are income methods that I can apply in here that will take advantage of this movement without introducing any risk. Trades that are similar to the income method number 6 trade that I showed. In fact, I could have done income method number 6 here, and here, and here, and here, and here, and here, and here. I could have done income method 6 the whole way. Okay? You see, the income methods reduce the gap, but once we reduce this gap to nothingness, to less than 0, then we're bulletproof. And from bulletproof, Mike, we can still do these debit spreads, these plays that take advantage of the stock movement or lack of movement. Kind of cool.
Mm-hmm.
Can they be combined?
Absolutely.
Yes.
Mhm.
Let's see. How much time do we have left? I'm going to go ahead and show
It's
this.
11.
This is something
Yeah, it's 11 after 1.
we got exactly 4 minutes. Okay, folks, I'm going to push this link out to you. I pushed one link out to you for the what do you call it? The blog. I'd really like for you to give me some input on that blog. But here's a link for you to try a month of Power Options free. Okay, 2 weeks free, and if you decide that you want to subscribe to Power Options, you get another 2 weeks free. Okay, but here's why I'm going to recommend Power Options. Okay, just one thing about Power Options: this custom spread bill. Okay. Now, the stock, I'm going to look at DIA. If I've got the net costs of the stock and the put being less than the strike price of the put, we've got our hockey stick graph, but there's something missing. What's missing?
There's no break even. There's no red. There's no
You're answering
loss.
a lot of questions, it sounds like.
Mm-hmm. Yeah, there's no
Right.
loss there.
There's no possibility of a loss, but there's still an upside potential that's infinite, and there's also because you're long in the stock, you can also collect dividends. Okay, now here's what I'm going to do. I'm going to introduce a bear call spread. What we looked at, let me scroll down again. What we looked at just was 0.3% negative risk, or guaranteed $35. Basically, the setup that I showed from my 2006 trade, okay?
Mm-hmm.
Okay, where you own 100 shares of DIA, and you also, the net cost basis is less than the price by 35 cents. Now, we're going to introduce a bear call spread. I'm going to sell the April $125 calls, and I'm going to buy the April $129 calls, and see what happens. Okay, right now we've got 35 cents guaranteed back to us. Now, oh looky, by doing this we would realize a credit of, what is that, 91 cents?
Yes.
We realize a credit of 91 cents, and we'd turn around and make our guaranteed profit $102 a share. I'm sorry, $1.02 a share, or $100 for every 100 shares. Pretty cool.
Mm-hmm.
Could we continue to do that over?
Yeah, and that's what most of the questions that we are answering is that there are ways to adjust this that are discussed in the blueprint. If the stock starts to go above that short call strike price, there are techniques to adjust that are discussed in the blueprint to manage income method number 6. And if it gaps up suddenly, you know what? It's okay, because the loss that we take on that bear call credit spread of $5 minus the net credit we received in that one scenario we showed on NTAP would have only been $3.74. But in order for that to happen, we still gain $5 on the stock.
Right. Right. It basically introduces the trade that takes a credit. If the spread goes against you, you still make money. It's kind of cool. I'm going to ask folks just 2 more final poll questions, Mike, and then we're going to be out of here. It's 11:13. I want to let everybody go by 11:15 my time, 1:15 your time. And of course, this is recorded, so if you need to sign out, you can take advantage of the offer later. Okay. I just want to make this available to you, and wanted to know what you thought. What did you appreciate about today's webinar? Did you like the income methods that don't cap the upside? Do you like the fact that it was free? Do you like the idea of bulletproofing, taking a trade from low risk to no risk, but still holding it in place and having an unlimited upside? If you had a time machine, would you go back a year and do this? All right, let's give it another 2 seconds, 1 second, and presto. At one point it was 79%. Now it says 76% bulletproofing. That's our, oh no, our winner is this. 83% said income methods that don't cap the upside but leave the, but take a credit. Yay, pretty cool. Isn't that something? All right.
That can also
Mike,
be done with income method number 3.
That's right, absolutely. Just before an earnings announcement, you can make yourself bulletproof. Take advantage of the upside if the earnings announcement is positive, but not get hurt if it's negative. Okay, here's in our remaining 1 minute, I'm going to give the pitch, okay? I did tell everybody at the beginning that there was going to be a little advertisement, okay? I've shown you what's been the real problem. We've seen why it's gone unsolved. You now have a viable solution. 97% of you said that you'd be happier with your trading results if you'd only done the radioactive profit machine. You can see the difference now. You can start with very little risk, and then you can take your trade to bulletproof. You can even take income afterwards while still leaving the upside open. Okay? All right, here's the offer. What you get, what it'll cost, and what you risk. The blueprint is over 250 pages of instruction on limited risk and high potential return trading. There's 10 income method adjustments. You know, we just showed 2 of the 10. There's different adjustments that make more sense in different markets, and that's probably what most of the questions are coming in. Well, what if it goes down? What if it goes up? What if you're in a really volatile market? What if you're in a really quiet market? What if you're in a downward trending? What if you're in an upward trend? Hey, guess what? It's all in there. It's in the book. Okay? Along with the book comes a quick action guide to teach you how to quickly convert all of your trading, or a portion of it, into radioactive positions. There's the Foundations of Radioactive Trading CD, which talks about how to manage multiple positions in a large portfolio. And if you don't have a large portfolio now, you might in the future. Okay. And then there's a free month of power options, not a trial, but a free month. Okay. Here's what the blueprint costs. It's $339 plus shipping. That's $11 in the U.S., and I think it could be as high as $41 internationally.
Mm-hmm.
Okay. What if that $339 investment were a married put transaction, Mike? Well, would there be a way for me to make it bulletproof?
Yeah, well, if you could return it, for example, and have a guarantee, that'd be bulletproof, wouldn't it?
That'd be bulletproof. Okay, you have $0 at risk, and you can keep the bonuses. Okay, we guarantee. I'm so confident that you're going to want this. That I want you to read the first 3 chapters, and if you decide it's not for you, man, send it back then. Okay. In fact, you can read the whole thing and then send it back. Okay. Here's the deal: you get the blueprints, the quick action guide, Foundations of Radioactive Trading CD, and month of power options. If you purchase those separately, it'd be $557, but it's $339, and it's guaranteed. Okay. So, very good. Okay, Mike. Any questions that we didn't handle? Maybe we could field 1 or 2. I did want to let folks go, but if you are hanging on the line for a question to be answered, I'd like to answer that question for you. And if it's too detailed of a question, we'll handle it by email. Okay, go ahead, Mike.
I was just going to say, we got most of them, but most of them were revolved around, well, hey, now how do you manage that income method number 6? If it goes up, well, we talked about that. There are ways in the blueprint where you can manage it. And also, if it gaps up and it goes above both strike prices, well, that's okay too, because we've gained in the stock to counter that. That's why it's a nested trade and it doesn't add risk. Also, there was I just lost my train of thought. There was a question that came in, I apologize, on, it was the approach of income method number 6. Oh, 2 questions came in regarding this. Now, this is familiar to people who own the blueprint, but there are certain rules for the income methods, and one of the ones that is very important that's discussed in the sketch, it shows an income method in the sketch, that free white paper, and it's just selling a call. Selling a covered call against the RPM and turning it into a collar. But you never sell a call below the put strike price. With income method number 6, that can be done. You can sell the call below the put strike price as long as you're buying a call that still matches your SIGA model for the position. You always want to graph that out first on power options. Make sure it matches your expectations and your personal goals. So yeah, you can do that on income method number 6, but with income method number 1, you never, ever sell the call below the put strike price. Now, one other quick question that came in, I think one of our new attendees, I believe it was Phil, asked, why don't you just buy the call? Wouldn't you have the same risk? Now, we don't have time to go into that answer now, but if you go to radioactivetrading.com and you click on the blog, on the blog, run a search for long call versus married put, and you'll come across 7 or 8 articles where Kurt destroys that myth and describes why long calls are not the same as a married put.
That's right. Mike, I can actually show something. Can you see that right now, the illustration? for
Yes.
Cognizant Technologies?
Mm-hmm.
Oh, okay, good. Here's a way to begin answering that argument. Now, we already showed when you keep percentage risk down low that it has a profound effect.
Yes.
Folks that trade long calls and play a married put, they invariably risk too much. They invariably get into a leveraged position, which is too much for them to leverage. But there is a price difference too. And let me go ahead and handle that price difference. Mike, if you were to purchase the January 11 $80 call, okay, well, it would cost you $420 on the ask. On the other hand, if you were to buy the stock at $74.16 and also buy the $80 put at $9.90, well, your total invested would be $84.06, but that strike price of that put keeps you at $80 as your exit, okay? And so your maximum at risk is $4.06. Well, why the difference in the pricing? I mean, this is all ask prices that I'm showing. It's ask price on the stock, ask price on the put, ask price on the call. Why the difference? The difference is that a long call is not the synthetic equivalent of a married put. A long call plus cash on deposit earning interest is the synthetic equivalent of a married put. And so many options trading gurus leave that out. They take out the Black-Scholes pricing method, which essentially takes into account the fact that if you are buying a call, it's like having the amount of capital that you would use to buy the stock outright, but instead of buying the stock outright, you put it on deposit. That is accounted for by the market. Look at that. The risk is different. The cost is different. Okay? All right. Other questions?
No, I think that was just about it that we had
Very
coming
good.
in during that
Mike,
wrap-up.
Very good. Mike, I've enjoyed my time here today and always enjoy working with you. Group, I want to thank you for coming out on Tuesday and spending your time with us, and like to encourage you, if you haven't already picked up the blueprint, that you do so. And if you have any questions, of course, you can direct those questions to support at radioactivetrading.com. Let me go ahead and put this up. Bam. Support at radioactivetrading.com, and you can also call this number, the Power Financial Group, any questions regarding the delivery of the blueprints and your Power Options subscription. Okay? Alrighty. Mike, thanks a lot.
Well, Kurt, hold on one
go
second here. I'm just going to do something. If you just, Phil said, I believe it was Phil sent in another question, where's the blog? Just go to radioactivetrading.com and click the blog. I'm going to send the blog to everyone right now. Just wanted to wait for 1 second here. And Kurt, you did this at the beginning too, right?
Yeah, let me send it right now.
I got it.
Oh, you got it?
Yeah, I got it.
You're so cool.
There we go. Okay, so it's just blog.radioactivetrading.com. You can click on that. And as I mentioned, Rob just asked this. For those questions on the long call versus married put, just enter in a search for long call versus married put. But Kurt's got some recent postings there as well that you can review through. So it's just blog.radioactivetrading.com, or simply go to radioactivetrading.com and just click the blog tab at the top of the screen.
Ta-da. All right, very good. Mike, I'll see you in 2 days. Nice working with you, and we'll see y'all out there, folks, online still. Happy trading, and goodbye for now.
All right, bye-bye.